Hey everybody, I hope everyone is doing well and had a good day. And in this video, I'm going to review the Emini 5-minute chart for Wednesday, October 15th, 2025. Just quickly, I want to talk about the higher time frame context, maybe not the daily chart. I was looking at either the 60-minute or the 120-minute chart. This is the RTH chart. Let me turn on the Globex chart so we can avoid some of the gaps. So I want to talk about the context here. Here's pretty much what we had going into the day. Again, this is the 120-minute chart. Huge bear breakout, huge bear bar, much bigger than all the bars to the left with follow-through selling. Major surprise, second leg down likely, but when we get so far below the moving average, the risk, as the breakout grows, we get far below the moving average, the risk increases, it gets bigger and bigger as the breakout grows. As we get further from the moving average, the bears want to see sustained control if they're going to sell this far below the moving average. And this happens from time to time. I should say it happens all the time. You see a breakout that gets really far from the moving average, it's unsustainable, and then the market tends to snap back to the mean. And by the mean, I mean the moving average. So what happened here? Big bear breakout, deep pullback. So now the pullback is strong enough for its own second leg. Market pulls back about 50% of this rally, the gap up in the buying. So we find support here. Bulls get a second leg. It's also nested. So leg one, pull back, leg two, and here, leg one, pull back, leg two. And look what's happening here. The bulls, they have a nested second leg. We're testing breakout points to the left. So where the bear breakout broke below support here and here, expect this area to be resistance. Overall, it's a big trading range. Big down, big up, couple legs up, one pullback, two, nested second leg, one pullback, two. And then this bar, specifically the last bar we can see on this chart, it's a bigger bull bar than all the bars through here. So this is basically a spike and tight channel for the bulls. There's a bull channel line in here, more clear on a lower time frame. And this bar, the last bar on the chart, is accelerating and breaking out above the bull channel line. The problem is that is unsustainable behavior. It's climactic behavior. The bulls are exhausted. They have a couple legs up to resistance in a trading range. And all of a sudden we're getting the strongest bar in this rally. So for a couple of reasons, it's basically a dueling lines pattern. Breakout of a bull channel and testing a breakout point. So you can expect resistance here. So kind of dangerous to be buying here. And I'm talking about all of this because it gets into what happened in the morning today. It can be so frustrating to see such a strong looking breakout on the open. And you think, gosh, I've got to get long. It might be a spike in channel, bull trend day. And, surely the bull breakout will get a second leg. We'll get a trend day after this. And then you get this kind of endless pullback. And before you know it, if you just rely on your stop loss below the breakout, you're stopped out of the trade. So I want to talk a little bit about that. There's two ways we can avoid getting trapped into being long here. Not that buying here is the wrong idea. I think it's perfectly fine to start buying closes on 6, 7, even 8. 8's maybe a little climactic, but one way we can avoid that trap is by looking at the higher time frame context, which we just did. So possible second leg trap on the higher time frames. So big bear breakout, trend line break, retest. Bulls hoping for a higher low major trend reversal. breakout, pullback, second leg. Again, it's nested, 1, pullback, 2, testing resistance to the left. So layers of resistance here. You can see where we're testing on the 5 minute. So you know you're buying. If you are buying, you're taking a chance that the market is in a bull trend, not testing resistance in a trading range, or betting that it's in a trend and the resistance will fail to reverse the bull trend. So assessing the higher time frame context is one way to at least be prepared for something like this to happen. But also we can think about the life cycle of a trade. If you're buying through here, what's your expectation for the trade? Are you scalping? Are you swing trading? What's the maximum drawdown or pullback depth you're willing to hold the trade through? But I think most importantly, you have to consider what's the context, what's the premise of the trade, what's the life cycle, how many bars are you willing to hold the trade? This is one of my favorite examples to talk about. Strong buy the close rally, but we have the higher time frame context, possible second leg trap on the higher time frames. So you can buy, but proceed with caution. There's generally a default exit for me here with bar 9 closing near its low. When you have a big bull breakout far above the moving average, and then you get a bear bar closing near its low, it might be better to just exit longs below the bar and then reassess, maybe buy again above a bull bar. But let's say you buy, or you buy the first reversal attempt, you buy the close of 9, you buy below 9. You have to ask yourself, what's the premise? Is this a strong buy the close bull breakout? Am I expecting a deep pullback, like 50% or even deeper? Or am I hoping this is a tight bull channel, pullback depth remain shallow, and the market resumes within maybe 2, 3, 4 bars? When you're buying far above the moving average, you need sustained momentum to justify taking the trade. The risk is big for the bulls, and the more we go sideways, the more disappointed the bulls will get. So here you can see it on the 5 minute. It's more clear on a lower time frame that bars 10 through 12 is a contracting triangle. So the market's in breakout mode. And again, you're far above the moving average. Sideways for 4 or 5 bars is not momentum for the bulls. So the bulls buying far above the moving average, they're paying a premium, and they want to see sustained momentum. If we start to go sideways like this, we can snap back to the moving average. Bear breakout of the triangle, and this is a good time-controlled breakout for the bears. There's a lot of overlap and there's not much price control, but there is time control, and more bars get added to the breakout. Before you know it, it's a 6 or 7 bar micro channel. First reversal attempt back up will probably fail, which means bulls need a second entry long. So that means sellers above 17, sellers above 16, 18, probably a minor reversal. Bears likely to get a second leg down, and then maybe the bulls will get their second leg up. And then the bulls never get their second entry. Is this a high 2? 21. So high 1, 17, high 2, 21. Technically, you can call it a high 2, but the channel down, the bear channel, is too tight. There's not enough buying pressure through here to be looking to buy. So really, nothing to buy. 21 is a reversal bar for the bulls, but probably sell the close and sell above. Another weak reversal attempt, a weak signal bar 23. Again, you can call it a big high 2, bull breakout, high 1, high 2, but the channel down is too tight, open gaps, very little buying pressure. So that's why 23 is also more of a sell above. A weak stop order buy setup is a good limit order sell setup. So this is a very low probability buy. If you buy above 23, stop below 23, your risk is very small, and you're buying against a tight bear channel. So the higher probability side of that trade is to sell above bar 23. Yes, we are testing the breakout point here. So possible hesitation and bounce here, but the approach is too strong. Bulls again need a second entry long. Then we go outside down 24 with follow through 25. The bulls don't get their second reversal. And now at this point, 25, strong bear breakout crossing the moving average. You know we're probably going to the start of the bull breakout at a minimum here. So probably going at least a little bit lower. And when a breakout like this fails to get a second leg in a big way, you'll often see a measured move the opposite direction. So the bears also have a target down here, which is near the close of yesterday. Always in short 25, important to be out of longs and okay to sell the close 25, possible measuring gap as well. So target here, target down here, and the close of yesterday. Is there support below bar 5 in the start of the rally? Yeah, there's probably support, strong enough rally. There's probably hesitation here, but again, the approach is too strong. Can you call this a wedge? 1, 2, 3 pushes down. It's 3 pushes down, but it's a parabolic wedge. It's a breakout on a higher time frame. There's very little buying pressure on the way down, and it's hard to justify buying when there's hardly any buying pressure. It's always in short, and the bulls need a second reversal before they start buying. So here it's probably sell the close, sell above 25, 26, and the bear breakout continues. Finally, a bull bar 30, but it's probably profit taking by the bears and not so much the bulls buying aggressively. Clearly a strong bear breakout here, second leg down, likely. And because we fell far below the low of the rally, it's possible we fall for that measured move here. But finding some support, some profit taking, maybe that's the measuring gap, measured move. We've reached on 27, so we're in that general area. You might expect some profit taking, reversal and follow through, 29.30. Strong enough for at least a small second leg up, but it's still always in short. So if you're short, you can expect the pullback to get a second leg, but nothing to panic about, especially if you're using the wide stop above 24. Obviously, stop above 24, your risk is big, but you also have high probability. If you're buying bar 30, you're taking the lower probability trade, smaller risk, but you're buying against a strong bear breakout. And the probability is that the bears will get a second leg down. 3-bar micro channel, bad low 131, probably buyers below, trapped traders selling above 29, creates temporary support. But after this much selling, any second leg up is probably going to be minor for the bulls. You can see the low one triggered, we found buyers, there's a scalp there. And for a scalp, you never get high probability and good risk reward. So usually the profit target for a scalp is relatively small. If you buy below 31, the target might be the high of 31. So outside up 32, but probably profit taking above 31. So this might be a sell to close bar, but this is still tight enough up that it may get its own small second leg. Still always in short, okay to be short. Bears attempting to resume with a low 2. Again, this is maybe too much up. Bulls may need a small second leg, and this looks like a pullback of the pullback rather than trend resumption. This does not look like the strong bears through here. It looks like it's a pullback of the pullback. Maybe we get a small second leg and then look for trend resumption. So the bulls get their second leg, 36. It's a big low 2. You can go to low 3, low 1 below 31, low 2 below 33, low 3 below 36, trend resumption, reversal and follow through, bear breakout 37. Probably good to sell the close and scale in. This is a higher probability trade. You're trading in the direction of the trend. You have a two-legged pullback to the moving average, and you get the bear breakout with a strong bar. Little overlap with the prior bar, not very big, so not very climactic. If you sell here and scale in, you're probably going to make money. As far as buying here, I would not. It looks like the bulls have had their breakout and second leg. This bear breakout still needs a second leg. It's very likely we test at least the low of 29, but strong enough breakout, we may get a measured move down. The measured move could be based on the size of the breakout. This gets you to yesterday's close. It could be based on the size of the bear flag, which is this minor reversal, which also gets you to yesterday's close. So sell the close, scale in. Probably bulls panicking out of longs here. If a bull is buying, they see 37, they're using 38 to exit. And then we get trend resumption. So this might be a, 6-bar micro channel. Resumption is too strong to be buying the first reversal, so double bottom, yes, 29 and 41, but you need a signal bar, and really you need it's better to see a micro double bottom, a second reversal, and the bulls never get it. So this is a failed double bottom. You can look for the measured move down, like I said, and that takes you to the close of yesterday. Big bars here approaching support, the profit target there. And at this point, it's no longer early in the trend phase. So I said 25 might be a measuring gap, but at this point, 43, 44 might be an exhaustive sell climax. Still nothing to buy, but this might be profit maximizing for the bears. And then 45, an even bigger bar, probably profit maximizing for the bears. Bears might buy to take profits, but it's definitely aggressive. I would not recommend buying bar 43, 44, 45 based on the premise that, well, the bears are probably going to take profits and we've gone too far, too fast. The reality is we're probably going to pull back soon. We have big sell climaxes far below the moving average. And again, when that happens, the risk just gets too big for the bears. The risk is huge. You need sustained selling if you're going to be holding on to shorts. And if the market starts to hesitate, we can quickly reverse back to the mean, moving average. So because it's a possible late leg in the trend and it's very climactic, probably not ideal to sell the close 45. Better to wait and take profits if you're short. Probably profit maximizing here. Reversal bar 46, kind of a default exit, like I said on bar 9. Consecutive sell climaxes far below the EMA, and then a reversal bar closing near its high. Better to just exit shorts above 46. For more information, 46 probably needs its own small second leg at a minimum. Reversal and follow through, probably buyers below, second leg up. 48 a low 1, but probably buyers below. Bulls will probably get a small second leg. And then the bulls ended up becoming buy the close through here. So does this look like a measuring gap or an exhaustion gap, exhaustive sell climax? So we might be testing breakout point up here. The start of the sell climax, 43 high. There's also a triangle through here. You can call it a triangle, tight trading range, area of agreement. So this might be an area where the market has to retest again. Sustained buying through here, but you look to the left and you know at some point you're going to find resistance. The breakout point, this would be a good profit taking area. The upside here is probably limited, but strong enough breakout. Sustained buying, strong bull bars closing near their highs, little overlap, not very climactic. This is a strong bull breakout. And the odds are the first reversal will be minor and the bulls will probably get a second leg up. So there's the first pullback. Very low probability short, bar 54 and 55, probably buyers below 54, 53. First bear bar and a lot of bars. after such a strong rally, probably buy the close 55 for at least a scalp. Some profit taking at the high of 55. Now the market's in the channel phase, so breakout, pullback, now channel. You can expect sellers at the new highs and buyers below bars. So 58, a weak second reversal, very little selling pressure, open gaps through here, and a small weak signal bar, 58, probably buyers below. Did not even trigger the buy until below 60, buyers below, and then again testing the highs, probably profit taking at the highs. And the bulls end up getting a spike in channel. There's also the high of yesterday, that's the blue line. And then I mentioned this trading range through here, which we're back in this general area. So we may start to go more sideways through here. Based on the market cycle alone, spike, pullback, channel, you expect a channel to become a trading range and not break out above the channel line. Most of the time, bull breakouts of bull channel lines fail within 5 bars in reverse and test the trend line. So there's a trend line to be tested, but also the start of the channel usually becomes the bottom of a trading range. So it's probably like 3 or 4 at this point, testing yesterday's high, which became resistance. We broke above it, broke below it. Once we broke below it here, traders hoping for support got trapped. Then this becomes resistance. We break far below it. We retest it again. It's probably resistance plus 3 or 4 legs up, testing a channel line. 67, a reasonable stop order sell. 3 or 4 bar micro channel. First reversal up, probably minor. 69, probably better to sell above. Maybe there's a deeper pullback, but second leg down likely. And then bears getting their second leg. You can see the channel evolving, breaking below the trend line, and evolving into a trading range. But now a possible second leg trap. Strong bear breakout, but leg 1, leg 2, testing near the start of the channel. So this may pull back here, bigger bar. Bears may take advantage, especially after such a big rally. Bears will take profits on a bar, like 74. And then you can see the reaction, and then a third leg down to support. So probably 77, more of a buy the close bar. And then outside up, 78, back to the top of the range. All right, that's going to be it for today's end of day review. Thanks everybody for watching, and I hope everyone has a good night.